is up, guys, and welcome back to the channel. If you're new to the channel, my name is Dave and I'm here to help you win with money so you can build your wealth. As a financial coach, you can tell if someone is committed to building wealth by the assets that they are focused on acquiring. In reality, each one of us individually has the option to choose to invest in assets that build our wealth or decrease it. And it's no surprise that people who build wealth invest in assets that grow their wealth, while individuals who tend to end up broke have a tendency to invest in assets that decrease or devalue their wealth. But what are the assets that grow our wealth, and what are the assets that decrease our wealth? In this video, I present the different types of asset classes and how they impact your wealth. Before we get started, consider adding me on Instagram. My posts are pretty much daily. Okay, now that we got that out of the way, let's get into it. It's important to note there are exceptions to every rule. And so while we're going to go into these categories, there are exceptions, meaning that there are some assets, for example, automobiles that are classic cars that actually appreciate in value over time. Those are not what we are covering today in the video. We are covering general categories and the general consensus that will be true about 90+% of the time. So first off, what are the assets that decrease our wealth? Let's look at these assets in order of the most impact to net worth, starting with assets that decrease our wealth. First off, cars. It's an unfortunate reality. Cars decrease our wealth. It's been widely reported that cars have a tendency to lose upwards of 20% of their value the day that you drive it off the lot. What is a way to avoid this? The best way is to buy a used car, preferably 3 to 4 years old. That is the time frame that allows you the least amount of depreciation and the most amount of room for value and equity on the purchase side of buying a vehicle. For me, I bought a 2016 truck in the year 2020. That gave me the lowest possible price point where the majority of depreciation had already taken place on the truck, so that I maximized the amount of value in making that purchase. And that is a great rule of thumb. A car from really about 3 years old is the sweet spot of when you can usually get the best value in terms of the maximum amount of depreciation has already occurred and you can get it at the best price. Next up, boats. Boats are notorious for not holding their value. They have a rough life, especially if they're out in the ocean, but boats tend to decrease in value significantly faster than a lot of other asset classes. So if you're buying a boat, you want to make sure that you've got room in your budget, that you have your emergency fund already in place, that you're investing at least 15% of your income towards your retirement, and that hopefully you own a home as well so that you have an asset that is appreciating in value. RVs. Recreational vehicles are notorious for losing value. And before you say it, yes, there was a period of time during COVID where RVs were appreciating in value and vehicles were appreciating in value as well. Again, that is an anomaly. That is not normal circumstances. And you might be thinking, maybe RVs are going to go in a different direction now that housing is so expensive. That might be the case. Rents are going up. We are seeing interest rates going up, and therefore a lot of younger generations, for example millennials, are choosing alternative means to live. That could very well be the case, but on the whole, RVs are going to go down in value, usually pretty sharply. Next up, electronics. Smartphones are the craze. We see folks buying $1,000 smartphones They want to have the latest of everything. And consumer goods is another place where we see this. These things tend to go down in value drastically the day that they come off the shelf. So, question to you is, do you really need the latest tech throughout all portions of your life? If you are an individual that is using your phone, for example, in your business, maybe you need a really good camera. I get there's a lot of different reasons, and ultimately that is for you to decide whether you want to make that investment or not. But generally speaking, electronics that are within 3 to 7 years old usually have the majority of the best tech already in them. So having something paid off, not paying interest on these things is absolutely critical, because these things lose their value so quickly that if you are paying interest on it as well, you're just sort of creating a snowball where you are hustling backwards instead of building wealth. Now, on to the good side, assets that appreciate in value. We're going to save the best one for last. So first off, investments. So in this category, we are thinking about things that are good investments. So number one would be stocks and bonds. The stock market as a whole has earned over 2,000% in returns since inception. Therefore, it is very well proven that if you are a long-term investor, meaning you're investing for 10, 20, 30 years plus, which is the majority of Americans, you can bank on the fact that stocks go up in value on average. You might see periods of time where things are a little bit different, which happens, but again, if you've got a long-term horizon, then you're looking at this over 10, 20, 30 years, and on the whole, you're going to be looking at, on average, anywhere from 8 to 10% average annualized returns by investing in quality index funds. Bonds are going to net you less of a return, but they are considered to be safer investments than stocks. So with bonds, people typically on average earn anywhere from 3 to about 7%. There are inflation protected bonds called I bonds that are really good in periods of high inflation. That is something that you can look into if you've got a longer term time horizon and you're looking to stash some cash away for a specific period of time without some of the traditional volatility of the stock market. Next up, real estate. On the whole, the majority of millionaires are made in real estate. I understand that right now we are in a time where rents are going up very quickly, interest rates are going up very quickly, but on the whole, usually real estate appreciates from 2 to 4% in various markets throughout the US, which is a great increase in return and a huge difference when we need to have a roof over our heads anyway. Real estate has made more millionaires than anything else, and so I believe that it will continue to be a huge asset in Americans' lives because we all need a roof over our head. So to be able to put a roof over our head and to be able to be growing our net worth at the same time is a win-win anywhere you look at it. Next, businesses. Businesses are a great way to build wealth, although they do come with risk. My first company, I went heavily into debt thinking long-term about my business and nearly failed the company after a year because the debt payments were so high that it was really a struggle to keep the thing afloat. I was able to hunker down, to get through it, to sell that company, and I made it out alive. But this is to say, businesses come inherently with more risk. And so if you're starting a business, you want to make sure that you do it based on a minimum viable product. That means get out there into the market, make sure that the business that you're running, A, has a market for it, and B, this is where people get so lost. Make sure that it is something that you want to do. You want to try this thing on before you go fully in, and especially fully into debt launching the business. You want to get the minimum viable product out there, make sure that it works and that there's a market for it. Make sure that you actually want to be doing this by testing it out in the marketplace before you start going deep into investing in it. So all in all, decide what you want to do. If you want to build wealth, you should be taking the bulk of your money and investing it into assets that grow. Doing the opposite will net you the opposite result. Buying fancy cars, quick way to lose money, quick way to go broke. So if you want to build wealth and you are committed to it, you're going to want to have a plan. If you don't already have a plan, download a free copy of my financial plan linked in the description. What asset are you looking to purchase in 2023? Drop it in the comments below. If you found value in today's video, do me a favor, smash that like button and hit the subscribe for all the financial tips, tricks, and motivation to win in financial life. And if you haven't already, consider adding me on Instagram. My posts are pretty much daily. Until next time.